Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, January 6, 2024. How you doing? Hope you're doing well. Hope you had a good week, and I appreciate you coming to my weekend review podcast, first podcast of 2024. So I am coming to you today from Colombia. This is the first podcast I've ever recorded from Colombia. I came down here, and hopefully my computer setup's going to work. It's all a little different down here, but hopefully we'll get through it. But yeah, thanks for coming. And here is the format for today's podcast. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily and the weekly time frames. We're going to talk about when I bought them, why I bought them, what the setup was, what my thinking was of why I entered the trade. We're going to talk about where I placed my emergency stop. We're going to talk about where I placed my end of day stop. We're going to discuss how I take partial profits if the trade moves in my direction. And then if it gets to a certain point above my entry, then I tighten up my stop, go into a trailing stop mode. But yeah, we're just going to talk about when I bought them, why I bought them, and most importantly, how I am going to manage the trade going forward, either to the upside or the downside. In trading, it is very important to have a process to tell you exactly what to do. One of the worst things you can do is just kind of not knowing what to do and just, getting in or getting out on a whim. I've been trading for 28 years, and in my experience, you'll always make more money if you have a good, solid process that tells you what to do, free of emotions, just based upon good trading fundamentals. And really what that comes down to is being patient, waiting for a confluence or a combination of indicators to line up. When that happens, you like the trade, make sure it gives you a good risk to reward ratio. That's very, very key. Position size based upon the current market volatility and your total trading account. Place that emergency stop, place that end of day stop, know how to take partial profits, and be very patient with your winners and be very impatient with your losers. That's the key. A lot of people, they like to hold on to their losers because they feel like it's going to come back. And a lot of times they do come back, but there are times where you'll get into a position where it just will go against you and keep on going. Trust me, I've been trading for a long, long time, and that's really the worst thing that can happen, because then you get stuck in that cycle. Oh, well, it can't go much lower, it can't go much lower. Well, it does, and it does, and it does. And you really wish you would have just taken that initial quick loss. With it stings a little to take a little bit of a loss, but trust me, there are some trades where you'll be so glad that you just got out. All right, so look for those combination of trades and be very patient with your winners. Have that process. Be very impatient with your losers. So we'll take a look at all the trades. We'll see how they're doing, and you'll notice that if I'm in a winning trade, I may be in it for a long time. If I'm in a losing trade, and I have many, it doesn't matter. I just take that trade. It loses, I'm out. No big deal. I just wait for the next one. You're going to have a lot of losing trades, but you have to have some big winning trades to pay for all those losers and to book a little bit of profit. Makes sense? So after we take a look at my trades, we're going to do a little bit on trader psychology. Always the most important skill. Everyone thinks about skill in trading as far as, this secret setup or some indicator. It's really not that. The real skill in trading is just having a good, solid process, but then the skill is in following that process. That is the key, having the discipline to follow the process. All right. And, before we get into these trades, just want to let you know, if you don't have a process, if you're not sure what I'm talking about, I do offer private one-on-one lessons in the evening time via Skype. I've taught people from all over the world. I love to teach. I think I'm a great teacher, and I teach all 5 of the different trading approaches that I use. So if you don't have a process, I can definitely help you with that. I've taught people from absolute beginners all the way up to the hedge fund level. So if I can help you with that, I'll talk a little bit more about it towards the end of the podcast, but my email address is in the link of this YouTube video. Just reach out to me and we can start a discussion And I know you'll be glad. You'll be a much better trader, I promise you. Okay, so after trading psychology, I have gone down through my master watch list, and I have identified some trades that I'm looking for next week. Now, these trades are not there yet. It's very important for me. My process is on the weekends. I just go through the list and I say, okay, if something really sticks out to me, then I'll mark it. If it gets there anytime next week or on Friday, if they're weekly trades, then I'll consider taking the trade. I don't have to take the trade. But that's what I'm going to outline for you today is I have gone down, and there are some good ones. There are some decent ones. You know, we've had this pullback in the market, which I was expecting was going to come. If you've been listening to the podcast, I was expecting that it would come, and it did. But now it's given some opportunities and some good opportunities. So we'll go through what I've marked up on the daily and the weekly, and next week possibly might enter those trades. All right. So before we get started, or let's get started, but before we do, I have to run the U.S. legal disclaimer. So hang tight for about 40 seconds, and I'll be right back. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, here we go. Let's get into the daily trades that I took on the daily time frames that I've been interacting with last week, and we'll see what's going on with them. Not too bad, actually. Okay, back here, this is Walmart, WMT. I purchased Walmart all the way back here on the 12th of December 2023. Now, why did I enter the trade? Well, very simply. You see the purple line here? This is the 250-day moving average. This is a key level of support. The black line is a key level of support as well. That's the 200. The 300 is a key level of support as well. Well, on the day that I entered, the previous day that I entered, it closed below the 200-day moving average. And then the day that I entered, it closed above. That's it. That was the entry signal, was the simple closing back above the 200-day moving average. Now, at this point, I have to position size based upon volatility and the size of my account. So let me pull this over here. Oh, sorry. My setup is way different here, down here, than it is over there. What am I doing? Okay, here we go. All right, let's just say we have a hypothetical $100,000 account. 1% of a $100,000 account is $1,000. If you have a $50,000 account, or if I had a $50,000 account, 1% would be $500. If I have a $1 million trading account, 1% would be $10,000. So let's just use the 100,000. So 100,000 times 1% is $1,000. Now, at this point, to position size based upon the volatility and the account value, I take that $1,000 divided by the value of the 2 ATR. You see it says average true range to here, 3.82. That's the average range of twice the daily expected range. So divided by 3.82 would tell me to buy 261.7. So I just rounded up to 262 shares. Now, so I saw the signal, the close under, close over the 200. I position size, told me to buy 262 shares. Now, I talk about an emergency stop. What's an emergency stop? An emergency stop is exactly $3.82 below, because that's the value of the 2 ATR. So I entered here, closed under, closed over the 250. I placed my emergency stop exactly the value of 2 ATRs, 382 below. So if the next day had it gone all the way down to the emergency stop, well, how much would I have lost? Well, I'd have lost 262 shares times $3.82. There's my $1,000 maximum loss. That's 1%. Never fun, but you can recover from a 1% loss. But the good news is only about 5% of the time is that ever going to happen. The other 95% of the time where it happens is going to be your end of day stop. An end of day stop would simply be the opposite, in this case, of why I entered this trade, because it closed below 250, over 250. If the next day it had just closed below the 250, I simply would have been out of the trade. Okay? That's the defensive part, the position sizing, the emergency stop, the end of day stop. Now, I have an orange line here. This is 1.5 above my entry. Emergency stop is 2 ATRs below. My trailing stop level is 1.5 ATRs above. So if I get to this level, if I get to the 1.5, then I go into what is called trailing stop mode, which means then if I have a close below a previous bar's low, I'm going to exit half the position. Now, one last thing, offensive part of the move, is if it moves the value of 0.45 ATRs. Right now, the value of 0.45 ATRs is 86 cents. Then I will get out of 10% of the remaining shares that I have. So let's just look at this for Monday. I take the current price, 156.71, 156.71, plus the value of the 0.45 ATR plus 0.86. My first profit target on Monday will be 157.57, right up here, right about here. And if it gets there, however many shares I have remaining, I'll take 10%. Now, that's the first profit target. Second profit target is I take the first profit target, add the value of the 0.45 to it again, 0.86. Second profit target for Monday is 158.43. And if it does reach there, then I'll take another 10% of whatever the shares I have remaining. And then the third profit target, same thing. Take the second profit target, add the value, 0.86. Third profit target, 159.29. So I do that every day. I just take the closing price, add the value of the 0.45 ATRs 3 times. Those are my 3 profit targets for the next day. So when I purchased this back on the 12th, close under, close over, purchased at 151.53. Well, the next day it moved up very, very strongly. I took 2 profit targets off. Next day went down. Next day up a little, but no profit targets. Next day moved up strongly, took another profit target. On this particular day, I got to my trailing stop level, which means now if I have a close below a previous bar's low, I will take half the position. Next day went up, not enough for a profit target. Then the next day here on the 20th, it did close below the previous bar's low after reaching trailing stop level. So as a preventative measure, I took half of the shares off for a gain of 1.53%. Then it continued up again, more profit targets, next day sideways, next day up again, more profit targets, couple days sideways, up again, more profit targets. So right now, this particular trade with the remaining shares that I have, up 3.41%. But the key is, look, I was very patient, waited for the signal, and it held. And look at this beautiful move up here with this very small risk. My end of day stop, even if it had closed 1 penny below, I simply would have been out. But that's the key to trading. Being patient, waiting for a major level like a 250-day moving average to be rejected, position size, place your emergency stop, have your end of day stop. And if you're wrong, be wrong small. If you're right, you have the potential for a really nice big up move. And again, remaining shares on Walmart up 3.41%. So that's Walmart. Let's go to USO, which is oil. All right, highlighted blue, 2 bars here with the blue highlighting. This is what's called a island reversal. And some of my favorite ways to trade island reversal and abandoned babies. And if you go to my YouTube channel, you see a free video there that I've done that explains island reversals and abandoned babies and why these are one of my very favorite setups. This one here, island reversal, simply means on this first bar here, see how we gap down? Then we have 1 day sideways, and then we gapped up. So from here to here, from 1 day, it gapped down. The sentiment was bearish. Then we had some indecision sideways, and then the next day, gapped up. leaving a space between these two bars to the left, leaving a space between these bars to the right. So sentiment changed very quickly from negative to positive, and that is why I entered. I could have entered right here, but I didn't. I just waited to see next day if we would come back down a little bit and kind of retest this gap, which we did. I got in here 66.02. Now on this particular trade, this is what is called well, in other words, I am risking 2 ATRs to the downside. This is the red line here, 4 ATRs to the upside. So on these type of trades, I don't scale out like I do on most of my normal trades. I basically say, okay, here's the entry signal. It's very strong. If I'm wrong, I'll be wrong 2x. If I'm right, I'll be right 4x. And I just let it play out. One of two things is going to happen for sure. I'm either going to lose 2x, which is 1% on my account, or I'm going to make 2x. It's very simple as that. And I like to have different trading strategies, different approaches. And on these island reversals and these abandoned babies, it's very, very simple. I risk 2x to make 4x. And you can see it's done pretty well. Currently, this particular trade on US oil is up 4.36%. Was up higher up here. But if it gets up to 4 ATRs above my entry, I will simply exit the trade. If it gets 2 ATRs to the downside, I simply exit the trade for a loss. But this one currently up 4.36%. SPY. All right. SPY, this is a short position, and so this one is kind of involved. You see this blue line and this blue line here. If you go way back in time, what we had an order block. And when you get back if you go below the order blocks and then back into the order blocks, they tend to fail and go down. Now, there's a lot of things going on with SPY here, and this is one of the reasons I shorted. You can see this high here. You see how tall the MACD bars are? That meant that there was very strong momentum. Then we pulled back into red, and then we got higher up here, but you see how even though the price is higher, the MACD is lower. This is called the double top with the bearish divergence. This was telling me that we're basically running out of buyers, and I thought we would pull back. So the reason I took this trade, and I shorted this at 474.10, for multiple reasons. One, we had this double top with a bearish divergence. Two, we rejected the top of that order block. Three, we had a V1 to the downside. And if you don't know what V1s and V2s are, go to my YouTube channel. And I have a video there. It's completely free that you can read about V1s and V2s. This one's a V1. And essentially a V1 consists of two bars. Bar 1, bar 2. Bar 2 went above bar 1's high and then closed below bar 1's close. So again, many things going on here of why I took this short. Double top, bearish divergence was 1. V1 to the downside was 2. 3, we rejected the top of the order block. So I got short here at 474.10. My stop, end of day stop, is this red line here, a close above the order block. And then, of course, the thicker red line up here is my emergency stop, same as all the other trades. Now, because this is a short, here's the orange line. This is exactly 1.5 ATRs below my entry. So if it gets there, then I go into trailing stop mode. And of course, if it moves down the value of 0.45 ATRs, I continue to take partial profits. And listening to myself explain this, I'm thinking, I don't know if anybody's going to understand this. My ex-students do, of course, and my current students do as well. But it's really not that complicated. And again, this is what I teach in my one-on-one courses. So, but as I'm listening to myself speak, I'm just like, I hope everyone can understand this. But anyway, I got short here at 474.10. It moved down strongly that day. I took a couple profit targets. I did get to my 1.5 ATR trailing stop level, which, because this is a short position now, if I have a close above a previous bar's close, I will get out of half the position. And I did. That happened here on the 22nd. It got down to my 1.5. and then this bar closed above previous bar's close. I got out of half of that position for a gain of 0.11%, excluding the big down bars that I had here. Then we continued up, we continued up, we continued up, did not close above my end of day stop, and then we've had this big move down. Big move down, took profits. Another day down, took more profits. Another day down, took more profits. And then the last couple days have kind of gone steady, no profits. So this particular trade, the remaining shares that I have on this particular short on the S&P 500, up 1.32%. All right. Next one, UUP, which is the dollar. Now, I like this trade right here. I got in here on the 28th. Why? Well, look at the black line. This is the 200-day moving average. On the 27th, we closed below. On the 28th, we closed above. Simple as that. A close under the 200, close over the 200. I position size. I place my emergency stop 2 ATRs below. My end of day stop is where? Why did I take the trade? That's right. I took the trade because it closed under the 200 and over the 200. Therefore, if we close under the 200, I'd simply would get out. Orange line up here, what's this again? 1.5 ATRs above my entry. If it gets there, then I go into trailing stop mode. And as always, if it moves up the value of 0.45 ATRs from the previous bar's close, I get out of profits. Partial profits, 10% of what I have remaining. So the reason I took the trade again, we had to close under, close over the 200-day moving average. In addition to that, we had a double bottom bullish divergence. What does that mean? I showed you this on the SPY, a bearish divergence. This is a bullish divergence. Look at the close back here. See how deep the red MACD bars are? Now look here. When I took the trade, is this lower than here? It certainly is. But you see how these red bars are not as deep as these red bars? It means it's running out of downward momentum. And if you run out of downward momentum, what it's insinuating is you're running out of sellers. And if you're running out of sellers, what's it insinuating is that it's going to go up. So double bottom, bullish divergence, close under the 200, close over the 200. I entered long here at 2702. Again, I position size, I place my emergency stop 2 ATRs below. My end of day stop is simply a close below the 200-day moving average. I place my 1.5 ATR trailing stop level above. And so I got it here 2702. Next day moved up a little bit, but not enough to take profits. But what was key on the next day, it gapped over these highs, therefore making this a island reversal, just like we talked about on oil, right? And so when I took the trade, we didn't have the island reversal, but the next day after I took the trade, it gave the island reversal and it supported my thesis on the dollar. And it also supported my thesis on the market going down because the dollar is negatively correlated with the market. And so when I saw this happen, I said, yep, we're going down in the market. That's exactly what happened. It's key, it's key to look at important markets like bonds, the dollar, to kind of give you an idea. Look at the drivers of the market. Bonds failed. They had an abandoned baby or a island reversal to the downside, bearish for stocks. The dollar, bullish island reversal, bearish for stocks. So on the 29th, it moved up. It formed the island reversal, but not enough for a profit target. Now on the 2nd, gapped up. So what did I do? It was a big gap up. I hit 2 profit targets. Next day, gapped up again, took another profit target into strength. I am at 1.5 ATR trailing stop level, but doesn't mean I do anything. The only time I'll do anything now after reaching trailing stop level is if we have a close below a previous bar's close. All right, so this particular trade doing well, up 1.42%. All right, next trade. India. India is a short. Let me clean this up a little bit for you. All right, this is an abandoned baby and a bearish abandoned baby that happened here. Do you see the blue? See how we gapped up? Sentiment was very strong, and then for some reason the next day immediately gapped down. So it's a gap up, gap down. That is bearish for INDA. And as with oil, this is a one or the other. You see the red line up here, 2 ATR stop, green line down here, 4 ATR gain. So one way or another, this trade is for sure going to play out where I either lose 2x to the upside or I make 4x to the downside. Which way is it going to go? I have no idea. Taking the trade with the bearish abandoned baby, the bias is to the downside, but it doesn't have to be, and it's fine. If it goes up here, I just lose 1% of my account. If it comes down here, I make 2%, and that's what it's about, having a good risk to reward ratio and making more on your winners, 4x, than losing on your losers, 2x. And this particular trade, it started off nice. Right off the bat, started down, and then we gapped up again. So let's take a look. This particular trade, down 0.41%. All right, so not all trades are positive, but the key is to, when you're wrong, knowing exactly. I know exactly how much I'm going to lose. If we get up to the 2 ATR, I'm simply going to lose 1% of my account. But this particular trade at the moment, down 0.41%. All right, Berkshire Hathaway. Berkshire Hathaway. Now, this is another one of the approaches. It's a little different than what I've been talking about today. This is called a return to value V2, and I do, again, teach these in my courses. Green line here, green line here. Anywhere in here is considered the value zone. I like to buy under value, sell in value, or buy in value, sell above value. Unfortunately, most retail traders tend to buy above value and then sell when it gets back to value. You should consider buying in value, selling above value. So why did I take this trade? Well, started here with this bar on the 13th when we closed above the 1 ATR channel. We closed above the value zone. We closed above value. Then we came back into value, right? The bars are inside this value zone. And so now that is a return to value. We were above value. We came back into value. We've returned to value, ready for an entry, but we need the setup. The setup came here on the 2nd of January with this V2. See this? Bar 1, bar 2. Bar 2 goes below bar 1 or washes out bar 1's low. Bar 3, as soon as it got above bar 1, that was the legitimate entry. I got long 357.92. So above value, into value, sideways motion, legitimate V2 trigger here at 357.92. So I position size as always. I place my emergency stop down here, of course, always. But on these particular trades, V1s, V2s, and again, check out my video on YouTube and my lessons playlist about the specifics of V1s and V2s, but you need a stop. Well, the stop is always halfway of the washout bar. This was bar 2. This was the washout bar. That's this red line here. So after I enter the trade, if it gets my 2 ATR emergency stop, obviously I'm out. But if I get a close below halfway of this washout bar here, that is simply my end of bar stop. I place my 1.5 ATR trailing stop level above, so if it gets there, then I go into trailing stop mode. And of course, as it moves up, I take partial profits with the 0.45 ATRs. I know, sounds complicated, but I promise you it's really not. So return to value, sideways motion, got long here, 357.92, took some profit targets during that day because it moved so strong. Next day, got to trailing stop level, and also took 2 more profit targets. So I'm just exiting on the strength up. Now, let me make sure. I want to see something here. Yeah. The second day of the trade, we got to 65.81. So I do have a rule. I have a lot of rules in trading. If I ever get to a 65, over 65 RSI, or 65 or higher RSI, then the 5 EMA, which is this light blue line here, this comes into play. It's a good trailing stop level. So now, because we got above 65 RSI, if I had closed below this 5 EMA, I will simply be out of the trade. So Monday, if it closes below the 5 EMA, I'm simply out of the trade. And I'll be glad that I took these partial profits as it moved up higher. If we don't close below the 5 EMA and continue to move up, then just continue to take partial profits. If we get to the 70 RSI, then a whole new set of rules come in where if I reject the 70 RSI, I'll sell half of what I have remaining. And then to get out of the entire position, I will, we have a close below a previous bar's low after rejecting the 75 RSI, then I am completely out of the trade. All right, is that confusing enough, everyone? I hope not. It's really not that hard. But at the moment, the remaining shares that I have on Berkshire Hathaway BRKB up 2.1%. So it's been a nice trade. All right, last but not least, on the dailies, on the open dailies, is Alibaba. Okay, I got long Alibaba back here on the 18th of December at 72.30. Why did I do this? Well, this is something that ICT, and you can look up ICT on YouTube. One of the approaches he used is the run of liquidity, structure change, pull back into a fair value gap. This is a level here, low. We ran the level here, or in other words, this went lower than this previous low. On this day here, we had our first, or on this day here, we had the first move above a previous pivot after running the liquidity to the downside. So level of liquidity, we go below that level. In other words, we run it. This particular day here, we take out the first pivot. Pivot's just a high with a lower high to the left, lower high to the right. On this day here on the 14th, we change market structure to the upside. It was down, obviously. Here it changed to the upside. We had another move up, and then it leaves what's called the fair value gap. I have it highlighted in blue. It's the low of this third bar. It's the high of this bar. This is why it's highlighted in blue. And whenever you change structure to the upside, you have this tendency to pull back. So as soon as you change structure to the upside, you have this tendency to pull back. If you have a bearish one, as soon as you change it to the downside, you have a tendency to have a little bit of a rally before it heads back down. But on this one, level of liquidity, we ran the level of liquidity, we changed market structure, moved up, and then you have that tendency to come back into the gap. And this is the blue gap where I bought it. All right, place my emergency stop here. I got long at 72.35. Place my 1.5 ATR trailing stop level above. And as it moved up, took partial profits here. Next day moved down. This day up here, big move up on Alibaba. Took more profit targets, and now I'm in trailing stop mode. Move sideways, had another move up, took more profit targets. Day is sideways, another move up, took more profit targets. Every time I take profits, I'm reducing my position size and reducing my overall risk. And then this day here on the 2nd of January, we had a close below a previous bar's low after reaching trailing stop level, and I booked half of a gain of 3.26%. All right, then we moved up, more profit targets, and then the last 2 days we have been down. So I booked half profit targets at 3.26, and the remaining shares up 0.92%. One thing I don't like about this trade, and maybe you've seen it, do you see the island reversal, the bearish island reversal here? Yep, I'm long the trade, but this bearish island reversal, you can see, really, really did work. All right, so remaining shares up 0.92%. All right, and then I did have Caterpillar, which I exited, so no longer in this trade, but this was a great trade, great risk to reward ratio. Why did I look, I took the trade all the way back here on the 1st of November, all the way back here. You see the orange line here? This is the 300-day moving average. So the day before we closed below the 300, the day that I took the trade, we closed above the 300. And I always talk about confluences, combinations of indicators lining up. Well, on this particular day, great indicators. Under 30, over 30, under 300, over 300. That's why I took the trade. 231.60 position size. Place my emergency stop 2 ATRs below. My end of day stop is simply a close under the 300-day moving average. Place my 1.5 ATR trailing stop level above. And then if it moves up, I start taking profits. Took a little profits here, took a little profits here, got to trailing stop level. Here, unfortunately, on the 7th of November was a close under the previous bar's low after reaching trailing stop level. It still was a gain of 1.31%, but as you can see, as it moved in the future there, I wish I would have had the full position, but I didn't, but at least I had a half, and that is why I sell half. We had 3 days of sideways motion. Moved up, took profits, moved up, took profits, moved up, took profits, some sideways motion. Then we just moved up, took profits here, took profits here, took profits here, and then we really started to rev up, took 3 profit targets here, and all the way up here we were above 65 RSI. And remember my rule: if I have a close below the 5 EMA after reaching a 65 RSI level, I get out. And that happened here on the 2nd of January. Here's the thin blue line, that's the 5 EMA. And then on the 2nd, we closed below the 5 EMA, and the remaining shares I got out for a gain of 20.96%. Is that not amazing? Especially considering I was just risking this very, very small amount here, and look what that happened. So real quick recap on the daily trades. Walmart, remaining shares up 3.41%. Oil up 4.36%. SPY, the short, up 1.32%. The dollar up 1.42%. INDA down 0.41%. BRKB, remaining shares up 2.1%. Alibaba, remaining shares up 0.92%. And Caterpillar, out of the trade, the remaining shares at a gain of 20.96%. Not bad. All right, let's head over to the weekly shares, the weekly trades. All right, everybody, here we go. XLF. I've been in this trade a long time, closing in on not quite a year, but almost a year. So if I'm in a trade for almost a year, would you think it's positive or negative? 100% positive, because if I'm wrong, I'm going to be out wrong quickly. So I got into this trade on the 24th of March last year. What was my entry signal? Well, here's the 250-week moving average. This is a weekly trade, weekly bars. So on that particular bar, during the week, we went down, we went slightly below the 250, and then the 200 and 250, and then we closed above it. I got long at $30.71. Do the same thing. I position size correctly. I placed my emergency stop 2 ATRs below. My end of week stop, because it's a weekly trade, is simply a close below the 250-week moving average. Now with the other trades, I have my orange line up here, which is my 1.5 trailing stop level. If I ever get there, then I go into trailing stop mode. And as always, if it moves up the value of 0.45, I take partial profits. So I got long on the 24th of March, 2023, 30.71. Next week moves up, I took profits. Next week moved sideways, didn't do anything. Next week moved up, I took profits, and I also got to trailing stop level. Next week moved up a little bit, not enough for profit targets, but because I'm in trailing stop mode, if I have a close below previous bar's low, I get out of half. Well, we went down, but we never closed below previous bar's low. Then we moved up, took another profit target, and then here on the 23rd of June, we had our first close below a previous bar's low. I got out of half of the position for a gain of 6.4%. Then we had over a month up where I took profits, sideways motion, took more profits, then we moved down for a month, sideways for a month, then we really moved down. On this week here on the 27th, had it closed below the 250, I simply would have gotten out, but it closed above. kept me in the trade, and then we've moved up ever since. Had another week up here, took lots of profit, week sideways, nothing. Another move up here, took profits off. Another week here, moved up, but not enough for profits. Another week, moved up, took profits, sideways motion. Then we had a huge move up here, took two profits. Anyway, I've been in this trade for a long, long time. This particular trade, remaining shares up 18.59%. We are at a 68 RSI level. We have not rejected the 70, but the 5 EMA comes into play because we're above the 65 RSI. If we close below the 5 EMA, I'm simply out of the trade. So the remaining shares on XLF up 18.59. But again, I just want to bring your attention back to look at my risk to reward ratio. I bought this because it rejected a significant long-term moving average, and had it closed below, I would have a small loss. But because I followed my process, remaining shares up 18.59%. All right. Last but not least, Johnson & Johnson. Why did I take this trade? All right, I took this trade about a month ago on the 15th, not quite a month, but closing in on the 15th of December 2023. Okay, confluence of signals here that I took. Black line here, 200-week moving average. On the week that I took it, during the week, it went below, closed above. It was a weekly intra-week rejection of the 200-day moving average. Now I talk about confluences. So this by itself was enough, but we also had a V2. Bar 1, bar 2 goes below bar 1's low, bar 3 closes above bar 1's close. Confluence of signals. Intra-week rejection of the 200-week moving average, plus cherry on top, V1 entry signal. I entered 154.27. I position size. I placed my emergency stop. How far below? That's right, 2 ATRs below. My end of week stop is where? Why did I take the trade? Because it rejected the 200. Therefore, if it closes below the 200, I'm simply out. Orange line up here is what? 1.5 ATR trailing stop level. We have not got there. And then I take partial profits. Next week moved up, but not enough for a profit. Next week moved up a little bit, not enough for a profit. But this week was a strong week for J&J. I did take profits. I'm not in trailing stop mode yet because it has not reached my 1.5 ATR trailing stop level. But current trade doing very nicely, up 4.29%. So real quick, on the weekly trades, XLF remaining shares up 18.59%. Johnson & Johnson on the weekly up 4.29%. So all the positions doing very, very well. Only loss at the moment is INDA, and it's a small loss. So you're not always going to have weeks and months of this kind of move up. Obviously, we've had really, really strong moves up in the market, but the key is always to wait, be patient for those confluences, signals, position size, and then follow your process. So hope this is helpful. If it is helpful and you find it valuable, if you would hit the thumbs up button, if you wouldn't mind, I would really, really appreciate it. It really helps out the channel and lets YouTube know that there's some valuable content here. All right, let's talk a little bit about trader psychology before we start going over and looking for the trades for next week. This is from Steve Burns, good friend of mine, great author, great trader. Look up Steve books. You'll find many of them on Amazon under Steve Burns, and just a great trader, great author, great teacher, and Steve has taught me a lot of things. So whenever Steve mentions something, I take notice. Let's see what Steve has to say. A mistake is when you don't follow your rules. If you don't have rules in trading, everything you do is a mistake. And this is from Dr. Van Katharp, very famous trader, very famous author. But it gets back to what I'm talking about. You have to have rules. I have many rules. Everything's a rule in trading. Is it a pain in the butt sometimes? Sometimes, but you have to have them. They help your trading. They keep you safe. They keep you on the right track. And if you don't have rules, what do you have? You have nothing. You have nothing. You have just your emotions and your impulsiveness. So get yourself a good set of rules. One more time. A mistake is when you don't follow your rules. If you have rules and you don't follow it, yes, it's a mistake. But if you don't have rules, everything is a mistake. It's so poignant. It's so correct. So get yourself some rules. Get yourself some process. I can teach you the process, or go out and find someone else that can teach you a process, but you have to have a process that involves confluences, patience, taking partial profits, and very important, having a good risk to reward ratio. All right, everybody. Like I said, I did go down through my watch list. I had identified 9 potential trades for next week, 9 different signals or different tickers. Now, theoretically, all of these could trigger on the same day. It does not mean that I would take all 9 trades. I always have a rule where I only take the best trade of the day. And what makes the best trade? I mean, if we had 9 of them that triggered all together, how do I know which one that I'm going to narrow it down to? Well, I'm going to narrow it down to the one that has the most confluence of the signals, the best risk to reward ratio, the strongest relative market strength. It's stronger or weaker compared to the rest of the market. I'm going to look at the longer term charts, looking for some kind of support as well. And so, it's kind of really, when it comes to the skill in trading, to me, it's the ability to narrow down which one is the best trade. And again, this is what I teach in my one-on-one course. If you're interested in taking that, my address is in the email, or my email is in the link of this YouTube video. I love to teach. I will teach you a lot of great things. You're going to be a much, much better trader. So consider it. It's an investment in yourself. And it does cost $1,750. So it's significant, but it really is an investment in yourself to learn a skill, the skill of trading that you can use the rest of your life. Okay, let's start out with Apple. Now, I am somewhat excited about this trade because look at the black line here. The black line is the 200-day moving average. Look, whenever you're coming down to a moving average, look in the past and see whether or not it was respected. Well, it certainly was. Back here on the 31st of October, we closed below and then we closed above. This was a legitimate trade. And was there profit potential in here? Yeah, there was a ton. There was a ton. Well, look at this. Apple has been very weak. I was kind of expecting it. And you might ask why. Well, look at this. Look at this high here. Look how tall the MACD bars were, the green MACD bars. Then we pulled back to red. And then we went higher here. But look, you see how the greens were very, very low, even though we were higher compared to this high over here where they were very high. Or in other words, this is higher than here, but the green bars are lower than here. It means you're running out of buyers. And if you run out of buyers, the implication is you're going to move down. Did we move down? Oh, yeah, we certainly moved down. And this is what Apple is, in a way, is what's pulling the market down at the moment. But we are coming to a key level. And if you go back in history, anytime Apple has got to the 200-day moving average, it's been a pretty good bet. It has been a pretty good bet, and that's why we are here. So there are a lot of people watching Apple right this moment. Large financial institutions, hedge funds, good traders, they're looking to possibly key their trade off of the 200-day moving average, and that is what I am looking for as well. It doesn't mean it's going to work or be a profitable trade, but it is a perfect level to key off of. Now, I'm looking for one of 3 things. I'm looking for Apple to either go down, touch the 200, and bounce off it. It's the first. Second, that we go to the 200 during the day, or below the 200 during the day, close back above it. That would be another signal. Or simply we close below the 200 and then close over the 200. Just some sort of rejection of the 200-day moving average. We're at the 5th ATR channel, which is extremely, we have moved down. We moved from a 70 RSI to close to a 30 or under a 30 RSI. Now, we're at 2884. So two potentials here for me on Apple. One, we go lower and we reject the 200-day moving average, as I just mentioned. The second option would be if Apple closed above the 30 RSI. We're at 28.84, so we're below it now. So Monday, if we close above the 30 RSI, we'll probably have a V2, so it would be a nice confluence. Under 30, over 30, and a V2. That's completely legitimate. My end-of-day stop would be the 30 RSI. Or conversely, if we go down and reject the 200-day moving average, that would be my signal. But I have to wait for it to either go higher or lower and reject the 200. But I'm very excited about this trade. Doesn't mean it's going to work, but it's rare when you're able to buy Apple at the 200-day moving average or 30 RSI. So that is what I'm looking for next week. Either a move up where we close over 30 RSI, or we move lower, reject the 200-day moving average. Either one of those, definitely would consider getting long Apple. Adobe. Okay, Adobe's in the low 30s. RSI, we're at 34.44. Now, an under 30, over 30 would get me long. Now you see I have these lines drawn here. What is this? This is called a wolf wave. And let me take you back in time. The last wolf wave that I saw, I remember I pointed it out on this podcast. Take you way back in time here. Oh boy. Oh shoot. What am I doing? Let's see if I can do it this way. Oh, sorry. All right. You might say, what in the world is a wolf wave? A wolf wave is when you have 5 points. Starts with point 1, then you rally point 2. Point 3 is below point 1's low. You rally point 4, and then point 5 is the buy area. Point 1, 2, 3, 4, 5. This is the buy area. Was that a good buy area? Yeah, I would say it was pretty dang good. Okay, but I'm showing you this because of the wolf wave. Again, point 1, point 2, point 3, point 4, point 5. Point 5 in this area is the buy zone. Now, let's go back to Adobe, of why I'm telling you all this in the first place. We're getting close to a wolf wave. It's not there yet. Point 1, point 2, point 3, point 4, point 5 is down here. It's somewhere around here. Well, if the price gets down to that 0.5 area, we are also going to be a rejection probably or at the 30 RSI. So not only will you have a 5-point wolf wave, you could have an under 30, over 30. So it just improves the chances of this going up because of the potential wolf wave. We're not there yet, but if we do get to the wolf wave will coincide with a 30 RSI. So to make things simple, what I'm looking for is an under 30, over 30, either a close under 30, close over 30, or an intra-day rejection of the 30 RSI. And the cherry on top of this is that it's over that under 30, over 30. The rejection of the 30 is overlaid over a wolf wave. Make sense? All right. Walt Disney. All right. So Walt Disney, I've been talking about this for the last couple of podcasts. What I am looking for simply on Walt Disney is a rejection of the 200-day moving average, black line. Now, you see the gray line crossed over the black line? That's called a golden cross. You've probably heard of it. It's when the 50 crosses over the 200. Well, that happened. That's long-term bullish for Disney, but we still need a signal to get into the trade. And what I have noticed, and I've taught this to my students for many years, is that when you have a crossover, when you have a 50-200 crossover, very often you will move down. And the first rejection of the 200-day moving average right after the 50 crosses over it is a very good point. So this coming down to the 200-day moving average, normally I wouldn't get too excited, but because it's happening, but because the 50 crossing over the 200 just happened, any bounce or rejection of the 200-day moving average would improve the chances of this being a positive trade. Doesn't have to be, but it improves the chances. So just to make it simple, because we had the 50 crossing over the 200, now I'm just waiting for any rejection of the 200-day moving average. It would give me long Disney. FedEx. All right. Well, FedEx had bad earnings. I am looking for some kind of rejection of the 200-day moving average. I would have considered taking this on Friday, but I couldn't trade the full day on Friday because I was traveling to Colombia. But so I didn't take it. This would have been a legitimate trade because it bounced at the 200-day moving average. But I'm going to be watching this closely next week to see if we get another rejection of the 200-day moving average, maybe a V1, V2, something like that along with it. So this would have been legitimate, again, on Friday, but I was traveling, so I didn't take the trade. If I had taken the trade, I would have position size, placed my emergency stop 2 ATRs below, and then gotten out simply if we had to close below the 200-day moving average. So I'll just watch this, see how this works out next week, see if I can get even a little better risk-to-reward ratio, or perhaps even better, some kind of confluence like a V1, V2 along with it. MasterCard MA. Okay, I showed you on Berkshire Hathaway, the return to value V1, V2. We have potentially the same thing on MasterCard happening. Green line here, anywhere in between here is the value zone. So we closed above the value zone. We've come back into the value zone. We've moved sideways. Does that mean I can buy it yet? No, I still need a signal. V1, V2. Well, we are formatting a potential V2 for Monday because look, Thursday, bar 1, Friday, bar 2. Bar 2 went below bar 1's low. Monday and Monday only. If we close above bar 1's close at 419.77, then that will be a return to value V2 entry. Position size, place my emergency stop 2 ATRs below. And where's my end of day stop on a 200-day or on a return to value V1 or V2? That's right. It's a close below halfway of the washout bar. Friday was the washout bar because it washed out, or in other words, went below bar 1. So not a valid trade yet, but it would be a valid trade on Monday if and only if we close above bar 1's close at 419.77, return to value, V2. And my very good risk to reward ratio just closed below halfway that washout bar. So on Monday and Monday only, a close above 419.77, I would consider taking MasterCard. Nike. Okay. This is not a potential trade. But the reason I put it on here was because I wanted to show you, I talk about confluences and combinations of indicators lining up. Well, Nike right now is 30.93. If next week all we did was go under 30 over 30, and that's all we did, and we didn't have a V1 or a V2, if we just went under 30 over 30, that's it. That's all there is to it. There's no confluence there whatsoever. I would not take that trade. Now, Monday, if we gap way down, revert and go under 30, and reverse up over 30, and we also have a V1, then there's a confluence, right? There's a V1 entry trigger and an under 30 over 30. That's significant. But if all we do is just kind of go under 30 and over 30 and that's it, then I would not take the trade. Okay? Because there's no confluence. The more confluences, the more combinations of signals that you have, the better chance that you will have a positive trade. So I guess I shouldn't say I wouldn't buy Nike on Monday, because if it did gap down and reversed up, then yes, I would consider taking the trade. But if all it does is just go under 30 over 30 without a V1 or V2, then that's all there is. I wouldn't take the trade. Tesla. TSLA, I'm looking for some kind of bounce at the 200, some kind of rejection at the 200-day moving average. You can see in the past, did it respect the 200? Well, here it went under, over, then had a nice big run. Doesn't mean it's going to happen this time, but if it happened in the past, it's more likely to happen in the future. So if Tesla moves down, rejects that 200-day moving average, I would consider getting in the trade. Walgreens. Okay. You know, we were talking about structure changes and fair value gaps. Well, I didn't take this trade, but it's really good example. Look at this low here, level of liquidity, and then this level here. Did we go below this level of liquidity and run it? We did. And then the next day here, we changed market structure to the upside by taking out the first high of the first pivot. And then it left the fair value gap. So we had a level of liquidity, we ran it, we changed market structure, we pull back, and we create a fair value gap. Anything in this fair value gap would have been a legitimate buy. Would it have been right? I'd say so. But this is the opposite now. Look, we have a level of liquidity to the upside. We ran it. We crashed down. We changed market structure by taking out the low of the pivot point. So now we are in a bearish market structure. And what do you do in a bearish market structure? You short any rallies in the fair value gap. Well, there is a fair value gap. The blue, it's below this low here and this high here, the 3 bars. Anywhere in this situation here is a legitimate short. Well, that happened on Friday. Again, I wasn't trading because I was traveling. Would it have been legitimate to buy right here? Yeah. To short right here? Yes, it would have. But what I've decided, because I was traveling, if we get to the top of this fair value gap here, 258.88 here, that will be my short entry right there. Where will be my stop? Close over this high. Oh, one sec. Okay, so my entry for WBA next week, potentially, if it rallies higher, will be 25.88. Okay, so I'll position size. I'll place my emergency stop, of course, 2 ATRs above. And then my end of day stop will simply be a close over the first swing high. I'll mark it right here in the red. So this is a key example, everyone, of a run of liquidity, a break to the downside in market structure, and then that very likely check back or counter trend move up. But again, my short will be 25.88, end of day stop 27.04, and then my 2 ATR stop is the emergency stop. And then if I enter here, I'll place my 1.5 ATR trailing stop level below, and of course, as it moves down, I'll take partial profits. So we'll see. But this was a major break in structure to the downside, and so 25.88. Okay, real estate sector, XLRE. Okay, we talked about return to value, V1s, V2s. Here's the green line here. Here's the green line here. Anywhere in this area is the value zone. Again, it's a bad idea to start buying above the value zone. You want to buy in value, sell up here. You don't want to buy up here and then have your stop be down here. So this is the value zone, very clearly defined. We're above the value zone. We've come into the value zone now. We had 1 day of sideways motion, 2 days of sideways motion. My entry trigger potentially on XLRE, Monday only, 39.37. Return to value, some sideways motion, and a V2. So entry trigger, 39.37. So let's do a quick review. Apple, 2 potentials here on Apple. If we move lower in rejection of the 200-day moving average, that will be 1 potential entry signal. If we move higher, close above the 30 RSI, that is also a potential. So right now it's in purgatory. It has to go higher, above the 30 RSI, or lower and reject the 200. Adobe, looking for an under 30 over 30 would be the first signal, and overlay the wolf wave on top of that makes it a bit better signal. But under 30, over 30 is where I'd get interested on Adobe. Walt Disney moved down to rejection of the 200-day moving average in light of the bullish crossover we had here with the 50 and the 200. FedEx, some kind of rejection of the 200 next week. MasterCard, looking for potential return to value Monday only. 419.77 was what I'm considering. Nike, an under 30 over 30 by itself, not enough because it's not a full signal. But if we were to gap down or go under the 30 RSI, come back up over the 30 RSI and also signal a V1, that would be the entry signal. Tesla, 200-day moving average, rejection of the 200-day moving average would make sense. Walgreens, short 25.88 with the change in market structure to the downside. And again, real estate XLRE, Monday only, going above 39.37. So those are the dailies. And again, these all may trigger on the same day, but it doesn't mean I'm going to take every signal. I'm going to take the one. I'm going to narrow it down to the best of all the signals that triggered. Best risk to reward ratio, what had the most confluences of signals, relative market strength of this compared to the rest of the market, and then what it looks like on higher time frames. All right. And again, if you need help with this or any trading, just send me an email. All right. Let's go to the weeklies. All right. These are weeklies. These expire on a Friday. Now, this is something we haven't talked about in a while. This is Beyond Meat, BYND. I just mentioned several times about return to value V1s and V2s. This is a little different. This is called a higher low V1 or V2. Again, you have the green lines here that are the value zone. This one is the opposite. We need to close below the value zone, move into the value zone, which we had here. Obviously here, we closed below the value zone. Then we moved into the value zone. Now we had a pullback, and now I'm looking for a higher low V2, and it's starting to format. Here is week one. Week two went below week one's low. Next week only, if we close above 890, we will have a higher low V2 in place. MACD is green. This is a great potential setup. This is on Beyond Meat. Now, I'm not like a huge fan of this company because it has moved down so much, but this is a perfect signal. Close below the value zone, rally into the value zone, pull back, looking for a higher low V2, close next week, close of 890. Tesla. We talked about Tesla on the daily, also on the weekly. The 200-day moving average would make sense. And again, we had a 50-200 crossover. And if we move down to the 200, this would be the first rejection right after the 50-200 crossover. So this would make sense here next week, if and only if we reject the 200-week moving average. United Airlines. Okay, so on Beyond Meat, I was just talking about a higher low V2. Well, this already triggered. This triggered on Friday. Look, here's the value zone, green and green. We closed below it, rallied into it, we pulled back, and look, this is a beautiful V1. Bar 1, bar 2 goes below bar 1's low, bar 2 closes above bar 1's close. Again, I was traveling on Friday, so I did not take this trade. But next week, if we move down to the halfway of this bar, this is where it should hold. If I was in the trade, this would be my stop. So next week, if we get a bit of a pullback, a bit of a bit of a better price, I would consider entering it and using halfway of the V1 as my stop. Again, this is legitimate just as it is on Friday. But if it pulls back a little bit, then I'll consider taking it because it just gives me a better price on a valid trade. And then last but not least, I've been talking about VIX for a long time, but VIX does have a lot of potentials here. It has not signaled yet. Let's look all the way back here at these lows here. We have red MACD bars. Now we are much lower here than we are here. No red MACD bars. That is called the double bottom with a bullish divergence. It's very structurally strong. but we still need a signal. RSI right now is 28.10. If it were to close over the 30 RSI, I would consider getting in the trade. All right, so real quick recap on Beyond Meat. Next week, Friday only, if we're above 890, I'll consider getting long Beyond Meat. Tesla, if we move down and reject the 200, I'll consider getting long Tesla. United Airlines, if we get closer to the halfway of the washout bar, if we get closer to 40.60, I will consider taking it and then use that as my stop. And then VIX, again, if we get an under 30, over 30, I will consider taking the trade. So I've mentioned several times, I'm just going to do it one more time, but if you are interested in learning trading with me, I have a great course. It's one-on-one, you and I, in the evening times via Skype. It's 5 sessions. Each session is 3 hours. I teach you step by step all 5 of the different trading approaches that I've been using for 28 years. It costs $1,750, but it is a real investment. And by the time you're done with this course, you are going to know all these rules and you are going to be a much better trader. I promise you. And maybe you're a great trader right now, but I promise you what I teach you is going to help you. Now, email's in the link in the description. All you have to do is reach out to me and we can start a discussion. If you're not in the financial position to do the one-on-one, I have a really great online course on udemy.com. The link is in the description. It's very affordable, and I teach you one of the approaches that I use, which is called the deep dip buy stock trading strategy. A lot of what we talked about today was the deep dip buy strategy. So the link's in the description. Check it out. It's very, very affordable, and it's a serious course too. It's 9.5 hours, 26 videos, so consider that. Again, if you like the video today, if you found some value in it, if you learned something, please hit the thumbs up button or subscribe to the channel, or both. It really does help the channel, really helps me out, helps the channel out, lets YouTube know there's some valuable content. And then last but not least, please try to do something nice for someone today. You know, this world would be a much better place if we could all do one nice thing for another human being. You know, you like it when someone does it for you, so why not reciprocate, do it for them? And if you could also do one nice thing for an animal today, that would also be great. I was raised with many animals, and they really do appreciate. So one nice thing for a human, one nice thing for an animal. I promise you, we'll all come back to you one day. So anyway, greetings again from Colombia, and I'm going to be down here for a little while, and really beautiful place. Really enjoy it. And weather's nice and warm. It's beautiful. It's wonderful. So I'll be trading here this week, and then I'll be doing the podcast again next week. So if you have any questions today of anything I discussed today, please put them in the comment section. I'll do my best to reply. And I really wish you a good day and a good week next week. And get your signals together, get your process together, and always be careful, okay? All right, appreciate you being here. On the way out, I have to run the U.S. legal disclaimer, and God willing, I'll be back next week, and we will see what the market did. Thanks again, everyone. Take care.
U.S. government stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit, No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.